A warm welcome to the Carbon Equity webinar to discuss the launch of the Climate Tech Portfolio Fund 3. Thank you very much for joining and for your interest in learning more about the carbon equity funds. Lisa, if you could navigate to the next slide. Yeah, so today we're going to talk about the latest fund that we launched just a few weeks ago, Climate Tech Portfolio Fund 3, which is a successor to Climate Tech Portfolio Fund 1 and 2, our vintage year climate, venture capital growth, and buyout fund of funds strategy. The goal of this webinar is on our end to give you an understanding, to give you a bit of a preview of how are we thinking about the climate investment opportunity. How do we work? How do we select funds? And how does investing through carbon equity work? The other goal is for this to be really interactive and for it to be a forum for you to ask any questions that you might have. So feel free to actively ask questions in the Q&A chat. So there is a Q&A function. I think it's at the bottom of your screen. And we will monitor all of the questions and try to answer all of them during the Q&A. And if not answered, we will try to do so afterwards. Also, do feel free to introduce yourself in the chat with your name and role. Not obligatory, obviously, but nice to know who is here. Cool. So what we'll be discussing in this 50 minutes to 60-minute webinar is the climate investment opportunities, our view on this, the climate, venture capital, and private equity fund universe. What does the landscape of funds look like? 3, how are we thinking of structuring a portfolio fund? 3, what is our investment approach? How exactly do we do climate and general diligence on funds? And finally, how does investing through carbon equity work and why have others, approximately 700 investors to date, invested through carbon equity? So reasons to consider. Then before I dive deeper, very brief introduction of our team. So my name is Jacqueline van den Ende. I'm one of the co-founders and the CEO of Carbon Equity. And I'm joined today by Wiebe Visser, Managing Director of Carbon Equity. Wiebe spent 11 years with AlpInvest in the fund selection team and 5 years with JP Morgan in London. Liza Rubinstein, also co-founder and the Chief Climate Impact Officer of Carbon Equity. She started her career with McKinsey and is a specialist in energy transition and climate science and responsible for our whole impact framework and impact diligence process, amongst many other things. Then before we dive into the content, a few sentences on what we do for people who are not yet familiar with Carbon Equity. Carbon Equity, our mission is to unlock private capital at a scale of billions of dollars to help fund the world's most impactful solutions to climate change. And very concretely, we do this by enabling low minimum or democratized access to the world's best climate venture capital and private equity funds through fund of fund structures. And the choice for a fund of funds is a very explicit one because it allows you a very ample diversification by investing not in a single company or in a single portfolio of company, but in 150 to 250 different high growth climate innovations. And secondly, because through a fund of funds, you have the world's best climate fund managers who do the work of selecting portfolio companies for you. So it's a very sensible way of investing in this theme. We started in 2021, have approximately raised 200 million over the past 3 years with approximately 700 investors, both family offices, private equity investors, entrepreneurs, C-level professionals, next-gen investors, and other individuals who understand the opportunity, the financial opportunity, and the impact opportunity of investing in the climate, in climate innovation, and climate technology solutions. So with further ado, let's jump right in and start. So may I give the floor to Liza?
Yes, very happy to. Thank you, Jacqueline, and Thank you for joining the webinar. Such a pleasure. Let's talk a little bit about the climate investment opportunity. And it's very hard to tell the story without one doom and gloom story, because we're investing to solve a problem. There is a problem. I'll keep it to one slide. We're facing global warming. How much depends on the choices we make. So currently, based on policies, we're heading for 2.7 degrees warming. But if you actually take technological development into account, it's more like 2.3. Still not enough for the 2 or well under 2 that we need to face. Now, why is stopping climate change important? 2 degrees warmer every day is maybe not the big problem, but the problem is that climate will change and we'll have more extreme weather events. And I found a graph on the right-hand side from the latest IPCC report really telling. This is where you see how the hottest day of the year, how much hotter that will be with different temperature increases. And we see that if we face 4 degrees global warming on average, that means that the average hottest day will be 8 degrees hotter. And that's where the problem lies. And the same goes for floods and droughts and other extreme weather events. So definitely want to stop, limit global warming as much as we can. How do we do that? The great news is that we actually really understand rather clearly what set of technologies we need. It's a set of about 100. They're described in many different documents. All of the IPCC trajectories are based on them. The EU taxonomy also lists them really quite nicely. And all of these have been proven, at least in the lab, and that's really fantastic. But none of them are available at scale at competitive cost. And this is where the role of innovation really comes in. If you look at that set of about 100, 10% of them are right now at global deployment, meaning they are at price, at scale, at quality, widely available. Think solar panels and plant-based dairy. And then there's a whole bunch of them, about 40%, that are getting there. So we're talking heat pumps. You can buy them in many places. They're still maybe a little bit more expensive. They're still maybe not at full quality parity, but they're getting there. And the same, for example, goes for EVs. Then there's the bucket of early innovation. This is all of the stuff that we've really figured out to produce at a pilot scale. And now we're figuring out how to build big plants and how to do this at full commercial size. And here you can think synthetic fuels, hydrogen-based aviation, but also low carbon concrete alternatives. And then there's the 5% of the really tricky, potentially game-changing stuff. I see we have nuclear fusion on there. That's actually not fully proven in the lab, so it's the one exemption. But it's only a small minority of what we actually need. So at least when I discovered this, I thought, wow, solving climate change is a whole lot more doable than you might think it is. And innovation can really help us get them all to quality parity. And now another part that's important to understand is, especially for that earlier stage stuff, that 40% and that 5%, we actually don't know precisely what the winning technology within that will be. So here's a little bit of a busy slide, but the main story here is there's many different ways of producing low carbon hydrogen. These are 4 different companies from our portfolio that are doing it in different ways. It's very clear that we need hydrogen to decarbonize, but we're not really clear on what approach will be the most effective one and scale fastest and gain most market share. So on the left-hand side, you see a way of making hydrogen still gas-based, but we capture all the emissions that are created. And we also do it with light instead of combustion, so it's a whole lot more efficient. Then even within green hydrogen, there's 3 different flavors. I won't bore you with the details right now. And on the right-hand side, this is like a whole new thing that popped over the last 12 months. There's white hydrogen. Apparently there's a lot of hydrogen in the soil, and potentially we can extract it efficiently at very low cost and without creating any emissions. And Coloma is working on that. So we don't really know which of these 4 will win, but we think it's really worth betting on all 4 of them. And that's really one of the fundamental thoughts behind carbon equity. Zooming out again, right? So we need to get to net zero. We need to scale all of these technologies. These technologies are already scaling quite rapidly. And here's a few market forecasts of just how quickly they are expected to do so. So over the next 10 years, where here we look at 4 different technologies that will scale from 3x, already quite sizable things are still expected to grow 3x, like growth solar energy, plant-based food. And then the newer stuff, we're talking hydrogen, we're talking alternative aviation fuels. These will grow a multi-fold, or at least are expected to do so. And now the question is, why is that? And it's really because the climate tech momentum is there. And here are 5 drivers that we're at least really excited about. Let's start at maybe the bottom. So corporate action. By now, 4,500 corporates have not only committed to net zero, but developed detailed pathways of how they expect to get to net zero, which are independently verified. So corporates are really stepping up in their commitments to get to net zero for all sorts of reasons. But one of them is that either short-term cost savings or they can actually reap a green premium for what it is that they're doing, or they're looking to attract talent and see that that's really helping. Then on the left-hand side, global geopolitical competition. This has been one of the biggest drivers over the last 2 to 3 years, where the US completely changed the game with their Inflation Reduction Act, reserving hundreds of billions, but without a cap and potentially leading to trillions of climate tech support. And the big hack was that all of that support is dependent on the climate technologies being produced on US soil. And with that, they really kicked off the competition side of that, forcing the European Union, China, and many other countries to respond with their own policies. So suddenly, trillions is going into climate tech, and you see that directly leading to an uptick of, in our case, announcements, new factories being built, more companies getting funded. All of that is further accelerated by learning curves, where it's the more technology skills, the smarter we get, the more efficient we get at producing them, the faster we get them to cost parity. And these processes tend to be exponential. Together with talent and capital, a whole lot is happening and a whole lot is moving. And in terms of what is the size of the price that we're looking at, so today the total revenue from climate tech companies is 5 trillion in the global market, and that's expected to grow to 12 trillion in the next 7 years. So that's a 10% CAGR per year. And on the right-hand side, you see that that's potentially only still the beginning, because next to this market being expected to grow, there's also a lot of data on what kind of investments we actually need, and we still need to double our investments to potentially get to net zero. So this is the bigger challenge we're facing, the universe we're operating in, the space that gets us excited. And Wiebe will tell us a little bit more about what private equity doing is there.
Yes, thank you, Liza, and welcome everybody. Zooming in on the role of private equity in climate, I think one thing to understand is it's 99% of all the companies out there globally are not listed on the stock exchange. So if you really want to have impact and want to be able to invest in new technologies, it's done in private markets. But there are different types of private equity strategies. First of all, you have venture capital. I think venture capital really plays a crucial role in driving innovation. So from ideas or lab scale to the first pilot plans. An example in our current portfolio is Noon Energy. This is a spin out from NASA, and they're working on the next generation of batteries. And the advantage here is they can store energy for much longer than the generic lithium-ion batteries that are currently being rolled out, and also at much cheaper costs. So that's a really breakthrough technology. Once a company is a bit more mature and the technology is proven or a service has commercial traction, it requires growth capital to scale faster. And Soli is one example. It's a Dutch company that provides residential solar and residential batteries and software systems to manage it towards the grid. It's growing very fast and now raised capital to also grow internationally within Europe and potentially also in the US. Exciting company, not yet profitable, but growing very fast. And once a company is more profitable, it requires some private equity or buyout capital to further grow or win market share. And an example in our portfolio is Vacuum Schmelze. We invested in them through Arab partners, and they really make large-scale magnets being used in, for example, electric vehicles. So different type of risk-return profiles, but all really needed to drive the energy transition. And the good thing is, this market has really been growing for the past 3 years, year over year. So this graph shows you the cumulative number of deals and also the number of capital invested for really focusing on climate venture capital and private equity. So despite rising inflation and rising interest rates year over year, there has been growth. So that's very strong, especially if you compare it to the overall private equity market. So on the next slide here, you see the data. This includes private equity, venture capital, and infrastructure, but compares how climate has done versus the overall private market. And here you clearly see from 2021 a slump in the overall private equity markets, and including infrastructure, whereas climate has been relatively stable. So despite what's been going on macroeconomically, it is a very robust market segment within the overall private market. And the attraction is that there are quite a few tailwinds, especially for this vintage. It looks very appealing. You have the Inflation Reduction Act, for example, and in Europe, the Green New Deal, which really helps drive innovation. And for example, the Inflation Reduction Act provides tax credits for a variety of industries. It's over $1 trillion that it promises to provide to these new technologies, and that's a super booster. And at the same time, we see that valuations have been coming down, so it's an attractive time to invest in the space, especially on the later stage rounds. There, the valuations in the past 18 months have come down, and makes it a bit more attractive to deploy. So we're pretty bullish on the vintage for this program. Now, it matters, though, in private equity to actually get into the best funds out there. And it's difficult to get in there, but it's where we come in. But if you look at the return profile of the best performing funds versus the average performing funds, there's quite a big gap. And especially in venture capital, that's even more pronounced than in buyouts. So in order to do well here, you need to be able to get into the best funds. And that's a good moment to introduce our portfolio fund 3, because indeed, that's the type of access that we provide to our investors. What we are building is a portfolio fund, which is a fund that invests in multiple funds. So from 100,000 euros onwards, you can invest in this portfolio fund. And what you get is an exposure to 7 to 10, depending on how many good opportunities we see out there, underlying funds. And each of those funds invest in another 20 to 30 companies. So overall, your portfolio should be well over, it says here 100 plus companies. I think it should be well over 150 companies across all types of industries, but all focused on climate. And the diversification that a fund-of-fund brings is important. The risk return for a fund-of-fund is much better than for a single fund. If you look at the average multiple on the left-hand side, just for buyout funds, there it doesn't really matter that much. If you look at the return profile for a fund-of-fund versus a single fund. But on venture capital, it's really important to get into the best funds because the range of outcomes for funds is much higher in venture capital. So building a diversified portfolio helps creating better returns. So how do we select funds and how do we build such a diversified portfolio? It's a busy slide, but here you see how we break that down. We want to have some exposure to early stage venture capital opportunities in climate. So we'll probably pick 2 to 4 funds, and as a percentage of capital, it will be 20 to 30%. But the vast majority of capital going into early growth, which we define as Series B, Series C, and a few fund commitments to later stage and buyout funds out there. So it's really a mix of a bit more proven technologies versus still very early technologies. And ultimately, that diversification should provide you a very, very broad set of climate exposure. We have some, so can we go back? We have some ability to do co-investments as well. There we back the winners in the portfolio and we don't pay any fees and carry on those co-investments. So that's more attractive for our investors. Geographically, the split is 50-50 more or less, slightly overweight to the US, I think, but 40-60 at max, but we try to balance it. Move to the next slide. Yeah. One example of those funds that could end up in Portfolio Fund 3 is TPG Rise Climate 2. We're in diligence now on the fund, so no guarantee, but this is a fund that will raise multiple billions. dedicated to climate, and they've done that before, and they've done that well before. So we're excited about this opportunity. It's a very broad and experienced investor group, and the portfolio companies in their fund one are really exciting. So you have 12, which is synthetic aviation fuel. You have NPAL, which is a rollout of residential solar, and they do it extremely well in Germany. And these are backed by TPG Rise, and with such a big fund backing those type of companies, that they can really make or break some of these companies. And we like to get exposure to them. And you should expect that also a fund like this will do some buyout investments, but generally speaking, a route to exit is either selling to infrastructure players or listing on the public stock exchange. This is really 1 or 2 rounds before such a listing could happen. So a more mature fund in the portfolio. The pipeline looks very promising. If you compare the pipeline for Fund 3 versus when we started, you see more third-generation funds, some second-generation funds, but hardly any first-generation funds. There's no need anymore to back those first-time teams. We might do it occasionally, but we try not to. We really want to invest in more stable opportunities, and the more this market matures, the more of those opportunities are out there. And we have pretty good visibility on Fund 3, and some very exciting fund opportunities will appear. So we're keen to tell you more once we've done our diligence, but it looks very promising.
Jacqueline, I see that we've been getting quite a few questions. Shall we take a few now?
That is definitely a good idea. Maybe let's start with Diego. Diego asked a question: do you consider portfolio overlap coefficients when choosing funds or creating your portfolio funds, specifically to address the risk associated with a lack of diversification? In other words, how do we make sure that our funds don't invest too much in the same opportunities? Wiebe, do you have a view on this?
Yeah, I think from within a fund, I think it's unlikely there's a lot of overlap in the same rounds within a certain company. But it could very well be that a later stage fund invests in a portfolio company of Fund 2, for example, where a venture fund invested in the same company. So we do expect to see some of these companies, especially the winners, to show up and move from venture funds to growth funds to late stage buyout. I think that's a normal thing. It's a good thing as well. We hope to ultimately back most of the winners within this segment, of course. But within a fund, we will not invest in 2 buyout funds that go into the same buyout deals. That will not happen. We will really avoid that to happening. It should be sufficiently diversified, and within those 150, it should not be that much overlap, unless one company goes super fast and moves up from capital to growth within a couple of years. Could happen, but we try to avoid it.
Great. Then a second question that I'll take now is there is a big shortage in pre-seed, early seed capital in the climate tech space. This capital is usually provided by smaller VC funds run by emerging managers. Do you plan to include these types of funds in your fund of funds portfolio as well?
I think the amount of seed capital has been actually very stable, and also the valuations have been pretty high. So overall, within the overall climate space, we do think there's quite a bit of appetite and quite a few funds going after those opportunities. We like that exposure. We have in Fund 2 invested with @1 Ventures, for example. They go after early stage seed funds. That's a second vintage fund. I do acknowledge that there are quite a few emerging managers going after it, but the bar for us to go into a first-time team is extremely high. And we do think we can get seed exposure also in a Fund 2 or Fund 3 with a bit more, let's say, proven managers. We invested in Contrarian Ventures. They go after seed investments. And that's the second fund. So we're very we don't think we need to go into emerging managers that much.
Great. Okay, I propose that we take the next questions a little bit later and continue for now with the presentation. Thank you.
So Fund 3 is really a continuation. We've done 2 funds before. It's really vintage year program. So the first fund was our 2022 vintage fund, where we raised 42 million and we invested ultimately in 9 underlying funds. That fund by now is approximately 25% invested. The data you see here is from Q3, but we're obviously 6 months later now. So it's moved up to 25% invested, and it has close to 90% of substantial decarbonization within the portfolio. We'll explain it later, but it's for us very important, the percentage of substantial contribution to decarbonizing the planet. Fund 2 is the 2023 vintage. It's a 95 million fund, which we closed early this year. By now, we have committed to 7 funds. Actually, we recently made a 7th commitment and 1 co-investment. So well on track. We expect to make 1 or 2 more commitments out of that fund before we move on to actively deploying Fund 3. So we're well on the way there. And below, you see the split by stage and geography and sector of Fund 1 to give you an example how it could look like a portfolio construction. It's a bit too early to tell how the funds are really doing while they're still actively deploying, but some interesting data points do appear. So we have 24 companies within those 2 prior funds that have raised more capital in new rounds. So 2.4 billion in total has been raised by those companies. So that's quite meaningful. And 4 of those have become unicorn after our entry. So it's some early traction. We're happy with that, especially in the US. The IRA clearly helps, but we do see good portfolio developments in Europe as well. Just to highlight 2 of those companies that have become uniform since our entry. One is Form Energy. Also similar to Noon Energy, they focus on long duration energy storage batteries, really grid scale batteries. They're a bit further advanced than Noon Energy, so there's really a growth investment, and they raised 450 million Series E in October 2022. If you look at the investors on the cap table, it's really high quality. So we invested through Energy Impact Partners. You also have Breakthrough Energy Ventures, a name well known, Capricorn, and some strategics like ArcelorMittal and Eni. So it's really taking off. Great company, very promising, and similar electric hydrogen. They make electrolyzers for green hydrogen production. Fantastic product development, cheaper solution than incumbents, and they're growing fast as well. So they raised 380 million in October of last year. And again, here, if you look at the investors on the cap table, is extremely appealing. So we invested again through Energy Impact Partners. Also here you have Breakthrough Energy Ventures and Capricorn, but also strategics like Mitsubishi and Rio Tinto. So those are 2 examples of companies that are doing great, and we do expect more of those.
Cool.
Yeah, finally, we do invest across all the different industries, right? So it's energy transition and climate, but it needs solving across energy, mobility, industry, really anything that covers in the global economy needs to be addressed. So you should think of sustainable aviation fuel, steel making with electricity, so zero carbon steel, fertilizers without any carbon emissions. So it's across everything. That's the key message of this slide.
Great, Wiebe. Let me segue to a few more questions that we got. Mario van Teylingen asked earlier in the presentation, you spoke about valuation decrease. A lot of companies saw at least the prices or the valuations of companies go down, making it a attractive point to enter the market as an investor. What is the reason for lower valuations, or at least more reasonable valuation? What are you seeing in terms of valuation dynamics? And can you explain why we are seeing that trend?
Yes, for sure. So like I said, you really see lower valuations in later stage rounds. So where companies require a lot of capital. And what you saw in 2021 is that a lot of generalist venture capital funds and growth equity funds were also investing in climate. And some of them have disappeared. So clearly there's from the generalists a little bit less appetite. They're focusing on either AI or recovering all their overexposed assets in their main programs. But that has resulted in a little bit lower competition, I guess. In the meantime, though, the growth equity climate funds have increased in size. So they pick up the slack. And the good thing is they're just in a better position to negotiate at more attractive valuations. So you do see that rounds come together, takes a little bit more time, becomes a little bit more buyer-friendly. And that's a good thing for at least the funds that we invested in. You don't really see that dynamic earlier stages. So in seed and Series A rounds, there the drop has been less dramatic. There's still a lot of capital out there going after the more interesting companies. It might take a little bit longer though to close these rounds. So instead of a matter of weeks, it's still months or multiple months to get it done. So overall, a bit more buyer friendly, and yeah, one of the drivers has obviously been the increasing interest rates and the lack of liquidity out of other portfolios. So people are a bit more careful with deploying and selecting which opportunities they want to go after.
Cool. Great. Thank you. One other question I'd like to ask at this point, perhaps to Liza or Wiebe, is being a fund of funds, to what extent are you still involved in the strategy/decision making on the funds that you invest in as an LP? Or if you take it even further at the level of the underlying portfolio companies?
Let me start by saying so for us, it's really a matter of selecting the best funds. And ultimately, we are a limited partner, so we cannot influence what the general partner invests in. Right? They can construct a portfolio, they make the investment decisions. It's up for us to make sure that we're comfortable with their strategy and their execution, and that they will go after those companies that are either impactful and have the best return potential. It's really the combination of those two. So can we influence a little bit on the type of impact or the type of segments they go after? I think on impact, and Liza can maybe explain you a little bit better how we can influence it. On impact, we can at least steer them and guide them towards more impactful or better impact companies. But it's without actually having any decision-making power, right? We just do not have that, and we don't aim to do that, except for the co-investment sleeve. So on the co-investments, there we can make up which winning companies do we want to back with our program. But it's a small part of the portfolio.
And one part worth mentioning, Wiebe, I think, is that with our larger funds, we are writing bigger tickets, meaning that at times we've become one of the largest LPs in funds, meaning we join the LPAC. Maybe you could briefly explain the role of the LPAC?
Yeah, an LPAC is the Limited Partner Advisory Committee. Every fund has one. It only has on one topic real influence, and that's whenever there's a conflict of interest. On all the other topics, it can opine, but not influence. But it's obviously, you're close to the GP. You can talk to them more occasionally at a different level. I think another benefit of becoming bigger and writing bigger tickets is that you have more leverage and you can negotiate better terms for your investors. So we have been doing that now over the past weeks and months. So with bigger tickets, you can negotiate lower fees and other terms as well. So I think that's a benefit, but it doesn't influence how the portfolio is being constructed. That is really up to the GP.
Right. On impact, the story is more or less similar, where we do take a very active role with most funds. So in our investments due diligence process, we make a very extensive assessment of the climate impact approach of funds and also their past performance. We'll talk through that in a little bit more detail in a bit. But most important is that we have multiple conversations with the funds specifically on climate impacts. Many times they tell us they never got these questions before. Very few LPs go this deep. And we also share back our full analysis, and their funds tell us it's incredibly helpful and a good start for them to think of how they can improve their approach further. So we typically have conversations with them at that moment, and then after investing at regular intervals, we talk about how we can help them, how they can improve their climate investment strategy. It doesn't always lead to different companies being invested, but at least a very much more conscious approach of, do we really think this company is the right one for our company, for our funds, the most impactful thing we can invest in, and also managing and monitoring better after investing.
Great, thank you. I suggest we move on in the presentation.
Perfect. So let's zoom into a carbon equities approach, starting with the team. We have one of the largest teams globally that focuses really on climate private equity investing. And the team has been very stable for the past 3 years, and brings really a diversified background. So direct investment experience from Hall, from Peak, fund investment experience at Alpinvest. We have energy transition and climate expertise from McKinsey, and an impact investing experience from Phoenix Capital. So we really cover all angles here, and with this team, we can really map the global universe of funds. So that's really our core business, making sure we see all the funds out there, and with this size of a team, we can. We also leverage a broad network of advisors, some more informal than others, but they really help us get access to some funds that we have identified in the US. They make introductions, they set up meetings, so it's super helpful to be able to leverage them. And at the same time, we've also built strong relationships with other investors in this domain. And really institutional investors like Allianz, Temasek, Investanel. You see the names here on this page, and we regularly check in with them, compare notes, and that's super useful for our sourcing of the fund universe. So how have we built our portfolio so far? We started investing in 2021 with a direct feeder in 2150. And also in Astanor. But from that moment onwards, we really started deploying our fund of funds strategy. And with our annual vintage year program, we really try to invest in 7 to 10 funds annually. And we've been doing this from 2022 onwards successfully. So you see here some of these names. Some might ring a bell, others probably don't. But this is really what we want to continue now year over year. So 7 to 10 funds every year. That's the strategy. And if you look how those are scattered, so it's really a good mix between US and Europe, early stage and later stage. And you'll see that the early stage funds tend to be smaller funds, obviously smaller opportunity set, at least from the investment check size, and later stage funds require more capital. So it's very well balanced, and this is important. It's really execution of the strategy that I laid out earlier. The universe is also growing. So when we started in 2021, we spoke to 147 funds, and by now it's approximately 600 funds out there that are really in strategy investing into the climate domain. And we have regular contacts with them, some on a quarterly basis, some semi-annually, but we are in front and center in this universe, and we do expect this number to increase over the next years to come. So what does this look like? This is just a small subset of those funds, but it's really a very broad universe, both in Europe and North America, and some are really specialized on certain themes, like urban environment or food and agri. Other are really focused on buyout and then across all industries. So we try to cover all those angles, and and then the bottom line is there's sufficient opportunities to choose from.
Indeed, because from the 600 mentioned, we've invested in actually 16 so far. So there's one more since we last updated this slide. And let us briefly take you through how we actually select those funds and end up with that selection. So of the 600 funds we just mentioned, since we started deploying, so that was in the fall of 2021, 338 have raised capital, so have entered our funnel in this process. And from there, we've selected funds in a 5-step process. So it starts with doing a quick scan. This is basically, we have a first conversation with the GPs, with the team. And based on that and some initial documentation, we do a first quick analysis, no more than 2 to 3 hours of the fund on both general terms and on the impact side to do a quick estimation. How excited are we? What are the red flags we're seeing? And from there, we decide which ones to further prioritize. And of those, we've taken 34 into full due diligence, where we start with climate. So we're really climate first. For us, the financial due diligence and the performance of a fund is equally important, but because climate is such a strong filter for us, we've put that first. So in the climate due diligence, we look at 2 things, which we'll dive in a little bit more. But one is really how is the fund organized itself, its strategy, its team, its investment processes. And the other half is how in the past has this fund actually performed on impact. If a fund gets through that, and it's about half of the funds that we've taken into climate due diligence, proceed to the next stage, we do a full financial due diligence where we leverage the AlpInvest playbook, where Wiebe and Bas have very extensive experience there. They really know, they've really figured out how to do fund investing. So we've copied a lot of that. And next to that, we also do still an ESG and an SFDR analysis. So for us, ESG is really more understanding the material, environmental, social, and governance risks. So it's next to impact that we do this assessment. And we also assess to what degree the fund is aligned with Sustainable Finance Disclosure Regulation, which is a European Sustainable Finance Disclosure Regulation. Finally, we go to investment committee. We have 4 members on the investment committee. So it's Wiebe, it's me, it's Lara mentioned before, and it's our external investment committee member, Dirk Meuleman, CEO of Phoenix Capital. And we need to vote unanimously, meaning that both impact and financial performance needs to be there. On climate impact, let me take you through the high level. There's much more detail also in the data room. Happy to talk more if you're interested, but this is really the essence of it. We developed our own climate impact scorecard, our own methodology to do climate fund due diligence, basically because it didn't exist yet. Since then, we've refined this approach both through doing many deals, but also talking to many institutional climate LPs, gotten further feedback, and landed on this, what you're seeing here, where the first thing to note is the weight on the right-hand side, where you see many small numbers and then up to 50% at the bottom. So look at everything first, and you see that's the first half, and the second half is the track record. Looking at the first half, 4 things are really important to us. It's the mandate, so it's really how specific is a climate fund in what kind of climate impact they're targeting, and whether they exclusively focus on GHG mitigation or also have other environmental and or social goals, where we prefer the fully decarbonization focused funds. On the organization, we look at 2 things. We look at the climate knowledge of the team, but we also look at how climate impact has been organized. Who is responsible for it in the team? What is their mandate? How much time do they have to do this? How involved are they in the climate impact ecosystem? And are they getting the right knowledge to further update their approach? And then the biggest bucket, the investment decision, that's really also the most important one for us, hence its size. And it's about how is climate impact really integrated in the investment process. For us, how the capital is allocated is the single most impactful thing you can do. So active ownership and management and contributing to the ecosystem is all also important, but the single most important thing is where is the money going to? Which companies are we helping to scale? And so there we look at the full process, starting with deal sourcing. How is this team doing research on what the most important impact themes are to invest in, and how are they picking specific technologies? In due diligence, how are they quantifying the potential impact of this investment? Are they looking at the broader systemic impact of these companies and how they compare to peers, etc.? And finally, is all of that information, is there a very clear way in which that's weighed into the actual investment decision making? After that, there's monitoring and reporting. This is a little bit more status quo, I'd say, nothing much new there, but still important. And finally, the track record. For here, I'll keep it brief, but what we started doing is that we look up to 3 funds back if these funds have had the same strategy as the current one we're looking at. And deal by deal, for every single investment made, we assess how important that company's product or technology is for getting to net zero. And it's all about the potential impact. So many of these companies in which we're investing are still early stage, meaning there's not a lot of realized impact to be looking at. So it's really about how important is this specific technology or service or product if it reaches scale for getting to net zero. Next to that, we also do a general due diligence.
Yeah, and I'll take it over from here. So once we're excited about the impact opportunity, we'll do a more financial and generic DD on the fund and the organization. Because ultimately, we do not invest in concessionary capital. We do not invest in concessionary capital. It's really, we want market-based returns. And therefore, we zoom in to the team. That's very important. It needs to be a team with a relevant track record, either at this organization or at prior organizations. And we verify the track records through reference calls. This is probably one of the most important items that we focus on. We also zoom in on the organization. Is it institutional grade? Are processes in the right order? Do they have a high quality network of advisors? It really says something about the level of professionalism of an organization. Then we discuss the investment strategy. How have they set it up? And is it set up for success? Is it coherent? Do they actually do what they promise? So if they've done the first couple of investments of the fund, we zoom into those. And those obviously need to be in strategy. And we like to have some visibility on the first couple of investments in any fund that we invest in. And then finally, the fund terms. Those are very critical. We want to pay market-based fees. And therefore, we now can negotiate better terms as of recently. So it's a good development, but we want to make sure that we're well aligned with managers, that they also put in sufficient capital themselves. That's obviously very important when you invest in a fund. So we make sure that all these boxes are ticked, and only then we will go forward with a proposal to the IC. So zooming in on the terms and conditions for the Climate Tech Portfolio Fund 3, we aim to raise 125 million, up from the 95 of our Fund 2. The strategy, though, is the same, so 7 to 10 funds, like I described. And typically, those fund sizes are ranging somewhere from 100 million up to a couple of billion. There is a sleeve for co-investments up to 10% of the fund, but not 10% into one company. It will probably be up to 2% in a single co-investment, but in total, the number of co-investments will not be above 10% of the fund. And we aim to have a first close by May of this year. The duration is 12 years. The target net return is over 2x for this fund. We charge a setup fee of 1% for new clients, and for recurring customers, it's 0.75%, so they get a 25 basis point discount. And the management fee really depends on how much capital you commit to the fund, ranging from 30 basis points to 85 basis points per the ratchet on this slide. We do have a first close discount, so anyone who comes into the first close gets a 50% discount on their setup fee. So that's 50 basis points for new investors, and it would be 50% discount on the 75 basis points for recurring investors. Then if you look at the structure, it's a CV, so a limited partnership under Dutch law, and the minimum commitment is 100,000 euros. And for German semi-professional investors, it's 200,000. Now, I do want to point out Carbon Equity's ambassador program. So if you are an existing customer and you bring in a new client to us, a new investor, then both of you will get 5 basis points discount on the annual management fee. And there's a maximum of 5 investors you can bring on. So in total, there are 25 basis point discounts to be achieved. And that can be meaningful. So if you invest 500,000 euros, your annual you have a 0.25% discount, and that is already yearly 1,250 euros, and over the life of the fund, 15,000 euros. So that can be meaningful. One thing to state there is a floor of 45 basis points. So you cannot never go below 45 basis points. So it depends a little bit on where you start on your fee level, how low you can go. But it can be very attractive to refer friends to us. Please do.
Great. Let me segue into a few questions before we go to closing. A question on exits. How would you describe the potential exit valuations of the investments of your funds with a view of returning the multiples on your fund of funds, Wiebe?
So if I understand the question, how can we actually get there to these type of returns? I think it's important to note that whenever we invest in a fund, so for example, a venture capital fund, the underlying fund managers should be targeting for every investment they do a 10x at least. That should be the kind of the base case that they're shooting for on the venture capital side. Now, what does it mean on a fund level basis? Probably that it will end up at over 3x on at the fund level before their fees and carry. And if you then take those into account, you get to over 2.5 times at the fund level. That would be a good fund, a good venture capital fund. A great venture capital fund would be 5x and more. Hopefully we'll pick those. But for us, we cannot guarantee those returns, but we go after fund managers who have proven that they can deliver these type of returns in the past. There's no guarantee for the future, but there needs to be that ability and proof points that they can achieve these type of returns within their space. Now, in buyout, those returns are a little bit lower than in venture capital. In buyout, an investor would target probably 2.5 to 3x on each investment, and the range of outcomes is a little bit lower. So there at the fund level, they get to 2.5 plus, and that's so for us, it's really zooming into managers who have proven that they are capable of delivering these type of returns in the past.
Great. And then what other question from Brieux de Witte? Increase in size of your funds is very impressive. Well done. Is this a good opportunity to participate to the development of sustainable impact investing and basically to contribute to the ecosystem by supporting carefully selected first-time funds when fully aligned with your strategy? So what is our view on first-time funds, and when do we do that and when not?
Yeah, so we have invested in a couple of first-time funds. 2150 was one of them, for example. There we got comfortable because some of the managing partners had decades of investment experience at generalist firms, so they have been investing through the cycles. So for us, it's important that teams have that type of track records. It doesn't have to be at this firm, but there has to be track records in the past. If it's a team with no investment experience raising first-time fund, then it's not for us. The risk is too high. We see too many situations where either they cannot raise sufficiently sizable fund to really invest according to the strategy, or there's team turmoil quite quickly after the fund was set up. That's not the type of risk that we want to take with our fund. We don't think we have to take that type of risk. But therefore, overall, I think the vast majority of the fund will not be a first-time fund. But there might be one or two where we get comfortable for the reasons I mentioned.
Yes.
And I think worth adding to that, so as we are limiting our first-time teams, we are helping the ecosystem in different ways. So there have been multiple funds, whether they're funds 2 or 3 or 4, that are still taking longer to raise. This is something that we see more often. And by now, at least 3 of them were helping very actively to raise and get to viable size. Wiebe, maybe that's something you briefly want to talk about a little bit more.
Yeah, it's true. So when we were set up, we said we will not invest in funds below 100 million. And now recently we have kind of lowered the number in certain cases where we saw visibility or at least sufficient traction that we thought, okay, they might get there. So let us help them out earlier on in the fundraising process. Would never take full fundraising risk, but slightly earlier engaging with them, and then also introducing a lot of other institutional LPs to them so they can start dialogues with them. I think we clearly see a role for ourselves in that ecosystem, also towards other institutional investors. And that's the way we're helping them out. And in the cases where we have done that, it has been successful, and they have now reached the critical size of their fundraise. So it's good to be helping out in that way, but I don't want to end up in a fund ultimately that is really subscale and with a team that has no experience. I think that's just not for us, and we have sufficient funds to choose from, so there's no reason to take that risk.
Thanks. Let's move into the final 5 minutes. A few considerations on why people are investing through carbon equity. As I mentioned, approximately 700 investors, both professional and private investors to date, have invested through carbon equity. And the rationale typically is people understanding that it makes sense to have some exposure to diversified climate, venture capital, and private equity in their portfolio. It is obviously one of the most impactful investments that you can do. And secondly, it is a collection of high growth industries. So definitely a investment in high growth innovation. Secondly, people understand that when they invest in this climate theme, it makes a lot of sense to do so through professional, highly qualified venture capital and private equity fund investors. So out of this landscape, approximately 600 funds that are in our scope right now, we select the 7 to 10 best every year. And you basically have the world's best investors working or investing on your behalf. The third reason is diversification. So what we've seen is the landscape of private equity and venture capital funds is relatively young. Typically, we're invested in a fund 2, a fund 3 maybe, and rarely in a fund 4. So there is less track record of these funds. And also from an impact point of view, there are quite a lot of different claims on what the climate impact of these different funds are. So therefore, having a highly curated selection of these funds, but also diversifying your risk by investing across different investment stages from early stage, late stage, across Europe and the United States makes a whole lot of sense and is a very critical strategy to mitigate investment risk. And lastly, we try to make investing painless, fun, and engaging. And we do that in several ways. I'll give you a little bit of a preview of our platform in a little bit. So actually, if we skip to the next slide, Liza. So Carbon Equity tries to engage our investors in several ways. First of all, we have a web app. You can log into the web app. Current investors, and I think also prospective investors can do so. And you can see all of the underlying companies in your fund. You will also see what that company does, what problem they solve, what their technology is, and who the team behind it is. You have a news feed on what is happening within your portfolio. Soon we'll be adding short video bites to give you a personal explanation of what are these companies doing. And what is the success of the portfolio companies that you're invested in? So really try to keep you in real time, give you real-time updates on what's happening within your portfolio. Secondly, we organize annual events, 1 to 2 community events per year, where our community of hundreds of climate investors get together, get to meet each other. I always greatly enjoy these because it's a super interesting set of passionate and interesting people. With a shared interest in the theme of climate solutions. And third, we do a lot of education, webinars, insight series, blogs. I highly recommend signing up to Liza's newsletter, which she writes on a monthly basis with insights on what's happening within climate technology innovation. Now, if you want to get started, how to do so, it's pretty simple. You can go to the website. You can create an account. This is a 1-minute process. I ask you for your email address, your name, and that's it, I believe, your phone number. Then once within the web app, you can check out all of the fund information. You can download the investment presentation, and you can book a call with a member of our investor solutions team to do a Q&A call to make sure that you have all of your questions answered. If necessary, you can also speak to our investment team or Liza as our head of impact to go deeper. And then very simply through the platform, you can reserve your investments. It's a one-click effort. Once you reserve your investment, it is not yet final. We will ask you to confirm your reservation, and then it is final. You go through the onboarding process that takes anywhere between 10 to 15 minutes. And then you sign the subscription form upon which your investment is final. And then, of course, you may expect to receive real-time updates, newsletters, and invitations to our community events. So that is the lowdown of how to get started with investing through carbon equity. I hope we were able to answer most of your questions. There are a few more questions left in the Q&A. I'll make sure to answer these in person through email. And obviously, there's an opportunity to do a follow-up with my team, with Wiebe, Liza, myself, or any other people on the team, if you're interested to learn more and potentially invest in Climate Tech Portfolio Fund 3. Thank you very much for being here, and we hope to see you in the next webinar. We will share the video recording through email in a couple of days, so expect to see that, and it will also be on the website. Thank you very much.